Welcome back to the Williams Real Estate Channel. I'm your host, Geordie Williams. Today is a quick one. We are discussing investing with a partner. So this is Alex and I on our wedding day, but this could be your partner you may want to invest in with. Pros and cons. We'll discuss a few points. I'm getting people these days, some are investing on their own, some are looking to invest with a partner. So we'll discuss these points. So from the first point of view, additional capacity, your partner is obviously bringing in additional income if they are working. The other side of the coin, if your partner does not have a job, they would be a drag on your capacity. So these are the things you got to weigh up. Creative ownership structuring. So personal name, you can buy the property in your personal name, or you can buy a property in a trust. So then one of the partners or both of the partners can be trustee, or the other partner can be a beneficiary. So you can have one of the partners being the trustee of the family trust, for example, and then having another partner as a beneficiary to receive funds from the trust. So a good way to use the income from the trust to pay for other expenses for the other partner without the breadwinner receiving all the income and paying most of the tax to the ATO. So it's a good way you can create ownership structures or even shared ownership. So you may want to go 50-50, or you may want to buy them all in your wife's name as an example. So when it comes to a time of selling, then if you are the higher tax bracket income, you're not going to be paying the top dollar tax to the ATO. You can share the structuring of ownerships, but then you can also look at creative ways of getting the finance from the banks to maximize your borrowing power and your capacity to be able to grow your portfolio. One of the key points, number 3, is to make sure that your partner is on the same page with your investment plan. So I've had this a couple of times now, getting better at vetting potential clients that come on board. One partner may have all the exciting plans to build a portfolio, but they haven't necessarily briefed their partner with that. And in the final hour, it all falls apart when they have to brief their husband or wife of what they're looking to do, and it can fall apart. So make sure that if you do have a partner and you are going to invest with your partner, and your partner is a decision maker in your investment journey, make sure that they are on the same page and they're not looking to, for example, go and do a different strategy or save for a family home. If you're looking to build that solid residential foundation portfolio, a all-weather portfolio, I like to call it, I can definitely help you, but just make sure that your partner is on the same page. And make sure your partner is educated on the investment strategy. So sure, they might be on the same page looking to invest, but just make sure that they are across the strategy you're looking to adopt moving forward, because it can definitely throw a spanner in the works when there's a conflict between the partners. If one partner is going all guns and blazing, want to build a portfolio, and there's the other partner in the background who's more of a conservative approach and doesn't want to necessarily build a portfolio or wants to go down a different path, make sure that you're both on the same page and you are both educated at the same level before you start investing. Otherwise, it can just make things a lot harder, and you can get a lot slowly slow down your process with your investment journey. So that's a couple of things to have a think about. Next is investing with family. So I'm yet to invest with my family. This is a picture of us at the snow. We like to get down to the snow every year. That's my mother and my taller, better looking brother. So pros with investing with the family, a common one is parent guarantor. You can get your parents to be a guarantor if they're sitting on a property that's got a substantial amount of equity in it. So you can either use your parents as a guarantor to increase your borrowing capacity and or not need to raise the cash for the deposit. So you may be able to go 100% or 105% finance on your first property or two and use your parents as security on the loan to allow the banks to lend that money, provide your parents are guaranteeing the loan. So you can increase your servicing, your borrowing capacity, or you may want to preserve or hold on to your cash that you've saved up and go into the deal with 100 or 105% finance to cover the closing costs. It is possible. So seeing it more and more these days, especially with the first time investors looking to get into the market, using the bank of mum and dad is definitely more of a common theme. Number two is obviously additional capacity. If you're bringing your parents with a family home, or if you're partnering up with a sibling, a brother, if you're combining your incomes, you can get creative and do things like a joint venture, where, as an example, one person may have all the equity sitting in the property, the other person may have all the income from their job, and then you can combine those two to create the end goal of buying more property and doing more deals. You can also share your skill set. So one person may be into data, analyzing the markets, of knowing where the best next place is to invest in the market, and the other person may be good with construction. So as an example, my brother's a construction guy, works on big construction projects. I started construction, didn't work as long as what Rory has. I moved into property and then more investing, and I'm more skill set is around finding the markets, studying the cycles. But Rory has definitely a higher skill set in construction than what I would have. So at some point, it would make sense for my brother and I to do a joint venture where we could buy a site that is in a future zoning precinct, time it well off the 18-year land cycle, buy the site, use capacity from, as an example, my equity base, and use Rory's servicing as well as my servicing in terms of capacity to buy the site. And then when coming to build and say do a development, that's when my brother would then very complement a short-term investment play that would last 2 or 3 years to buy a site, develop it, and do a development to manage the builder. So that's when you can find, if you can find people that have a different skill set to you, or have either a more capital from a borrowing capacity perspective or equity, that's when joint ventures can work well. Make sure, though, if you're going to go down that route, is to make sure that your family is on the same page with your investment plan. So one family member may want to go to Europe every year and party up and do all that sort of thing, and the other family member might be setting up a family and kids and so forth, and goals change, people change as you evolve. So just make sure that your investment plans and your goals are aligned before you get into a joint venture, because if you go different ways, one person may be holding the other person back, and it can get messy. So next thing is to make sure that your family is educated on your investment strategy. So everyone needs to be on the same page. If, for example, your parents are sitting on a lot of equity, you could put that equity to work harder to start investing and build a portfolio or start development. Make sure that your family is also on that same page, on that same journey, and are educated in the space. So then it goes towards a successful project, investment journey, and outcome. As always, that is a bit of my thoughts, bit of our story of how both partnering up with other people can work and how it can slow things down. So food for thought. As always, this is by no means financial advice. You will need to talk to your tax accountant, solicitor, conveyancer, mortgage broker, everyone in your field. As a property investor, it is good to talk to everyone, your accountant, solicitor, mortgage broker, buyer's agent, everyone collectively, and then make your own decision based off your personal circumstances. Because if you only talk to one person, I see it all the time, people talking to their accountant saying they need to go and buy a negative geared property. That may be because the accountant's got the tax hat on. But if you talk to the mortgage broker, it may be a different story. If you go buy a negative geared property, it'll lock you up with the bank. So make sure you're talking to everyone and getting all a collective advice and making your own decision based off your own circumstances, as there's many ways to skin a cat. But if you need help buying an investment grade property to build a sustainable portfolio, an all weather portfolio, hit me up, send me an email, like, subscribe, comment. Until next time, thank you for watching.